let's hit inflation right at the top. Thursday's CPI came in at 0.2% month over month. Hotter than expected, and maybe more concerning, the core was hotter as well. Not the end of the world. Markets hit all-time highs again this week. But the moves in the bond market have been violent. Doesn't mean the market can't go higher. In fact, there's a lot of data here we should be excited about. But in the end, at a minimum, rates can be a leading indicator as to what's working, what isn't, and what's next. Welcome to The Money Runner. I'm David Nelson. Just a quick cut into this week's podcast. We had a follow-on piece of data to this week's CPI release. The PPI, Producer Price Index, came in flat, a little better than expected. The initial action in bonds is somewhat surprising, with yields across the curve pushing a little higher on the heels of a pretty tough week for bond traders. And I guess the bigger news this morning is the kickoff to earnings season with JP Morgan, BlackRock, and Wells Fargo, at least so far, up in the pre-market. To be fair, Jamie Dimon has been talking down the bank's numbers for the last couple of weeks and managed to step over, I guess, a lowered bar. A lot of work to do in these numbers, so look for some follow-up reports on my Substack site, dcnelson123 at substack.com. All right, back to the show. A lot of action this week. Stocks hit all-time highs. We had jobs numbers, inflation data, and of course, we kicked off earnings. I want to start off this conversation with a look at the S&P 500. Not because it hit all-time high, but look at that trend line. I bring this up because I find it notable. It wasn't that long ago. I had this same chart up here on this very podcast, and the trend line looked very different. I went back and got that chart. Now, look at that yellow band. That goes back to the October lows last year. Now, think back to what was happening then. Stocks were starting to roll over. But we started to get wind of the idea that the Fed was going to cut rates. We weren't sure when, but we were pretty certain it was going to happen. Stocks never looked back. We had a ferocious end to the year last year. We had a very strong first quarter that really held up through the first half of the year. Very, very strong upward movement. Then we kind of stalled out. And you can see the rate of change of this movement higher has started to slow. And you can see it in this next chart where you can actually see a rate of change indicator, that 45-degree angle up in the first half, kind of, stalling out for the second half. That's not necessarily bad news. In fact, it might even be more sustainable. But it does tell me that underneath the surface, something is likely changing in equity markets. Now, you can't have a conversation about stocks without having a strong conversation about rates, fixed income, and the Federal Reserve. Because in the end, most valuation models start with the risk-free rate. Now, look at the yield curve. You can see there the bond market has been violent. Very strong move higher in 5-year yields, 47 basis points in just 4 weeks. Now, that's not the playbook that we were handed when the Fed cut rates just a couple of weeks ago. The idea was that the short end was going to come down, and the long end was going to come down as well, but maybe at a slower pace, and the yield curve would steepen. Everybody in the bond market would make money. That's not how it played out. The short end has come down in large part because the Fed has cut rates. But the long end has actually moved higher, or at least stayed the same. So that rally that we saw in bonds just a couple of months ago, a lot of that's been given back. The question is, where do we go from here? Now, the strong jobs numbers, the hot inflation data, has maybe put the Fed back on their heels. And you're already starting to hear the narrative change. You're starting to hear Fed governors put out the message that, well, maybe we don't need so many cuts anymore. And you can see it in Fed fund futures. The idea of a 50 basis point cut in November, that's gone. And I was on board with that. I thought they would front load these rate cuts to support the economy so they didn't make the same mistake that they've made over the last half century. But right now it looks like a likely 25 in November. But then it becomes a little bit more nuanced. And you can see in this next chart, even though it looks like Fed funds are going to be coming down at almost every meeting, the terminal rate has been moving higher. Just a couple of weeks ago, the terminal rate where we think the Fed is going to end up was 2.75%. Now it's up to 3.3, and it's likely to climb from there. So the idea of what rates are going to look like, that's, at least in my mind, I'm starting to change my opinion here. I think long rates are going to be very, very stubborn for a lot of reasons. Why does it matter? It matters for me as an equity specialist. It's going to change what's going to work in the economy and in terms what sectors and what industries and what individual stocks are going to work. Now look at 10-year yields. That spike off the bottom there from 3.6% to 4.1%. What does that affect? Well, right off the bat, mortgage rates. Mortgage rates are in large part dictated by where 10-year yields are. So if you're out there and you're thinking, you know what, I'm ready to kind of sell my current home and move up to a better home, and yeah, I might have to go up in interest rates on my mortgage a little bit, but it won't be so bad. Well, now it's going to be pretty tough to do. You're not going to move from a 3% mortgage to a 6.5% or higher. For new home buyers, same thing. It's going to be a lot more difficult to get a mortgage, and in turn, do you really want to pay that rate? You're probably going to want to wait for something a little better. All right, let's shift again and turn to one of the indicators that's actually driving these bond yields, and that's inflation. We had CPI data on Thursday this week. For the most part, the headline number is headed in the right direction, but it was a little hotter than expected. You heard the month-over-month numbers at the top. What I don't like in this chart here is that blue line. That core number, that's something the Fed looks at pretty closely. That looks like it's stalled. In fact, it looks like it's even headed higher than where we are right now. Mixed data, when you look at the detail on the month-to-month, the only good news I saw was that owner's equivalent rent had fallen. Food prices, not good. Egg prices were up 8.4%. I'm sure all of you have been feeling that when you go to the grocery store every week. Jobless claims, hot data, way, way hot. We were expecting 254,000, came in at we were expecting 224,000, my bad. And we got 258,000. That was a big jump. When I first saw that, I said to myself, well, that doesn't jive with that jobs report that we got earlier in the month. Just doesn't make sense. And then I thought about it. And I think what we're going to find is that the hurricanes that we're seeing in the southeast are really playing havoc with jobs. I'm sure a lot of people got laid off. This is showing the effects of Hurricane Helene, and I suspect next week we'll start to see the effects of Hurricane, I guess it's Milton. And I was also venture a guess that you're going to probably see estimates for the jobs numbers that we'll see in November, which is a look back to October. That could even be under 100,000. But I think of that as a one-off and not indicative of necessarily a bad jobs market. All right, let's shift gears to equity markets. I want to talk about the narrative that's been out there for the better part of a year that this market is being driven by nothing but that magnificent seven stocks, those large cap secular growth names. And you know the names: Apple, Microsoft, Alphabet, Amazon, Tesla, NVIDIA, Meta. Look at that chart. That's year to date. And that's all of the Mag 7 stocks. And you're going to see a very interesting story here. At the top, NVIDIA, we know that, 167%. Underneath that, Meta, 67%. Very strong numbers. But now zoom in take a look at that chart. That white line, that's the Magnificent Seven. Underneath that is the S&P 500. Those other 5 stocks from the Magnificent Seven, they're underperforming the S&P. Look at those names. Apple, 203 stocks are performing better than Apple. Microsoft, 291. Alphabet, 244. Amazon, 182. And Tesla, 416. So if the market's hitting all-time highs and those stocks aren't really the leading cause, and it's NVIDIA and Meta the only 2 that are working, where's all this strength coming from? Something else has to be going on out there. And it tells me that there's a lot of strategies out there that are in fact working. Dividend stocks are working. There are value stocks that are working. There are other industries that are working. Utilities are working. In fact, I think the best performing stock in the S&P 500 right now is actually a utility stock. So there's a lot of good news in these numbers here. And we're going to have to start thinking outside our comfort zone as to where to put capital. Markets hit an all-time high. Nothing changes sentiment like price. Doesn't mean everything's hunky-dory. We still have a lot of challenges. We have an election coming up that's the most divisive in a generation. I suspect we're going to see lawyers with parachutes diving into counties looking for votes. We have geopolitical chaos on 2 sides of the planet. Every corner is a hot spot. So we have issues. Not to mention the fact that, this market is pretty expensive. And if rates climb much higher from here, stocks aren't going to like it. But all in, you have to respect the price action. There are things out there to buy. And don't forget, we're still in a market, running on an investment theme that's maybe the most powerful in a generation, and that's, of course, artificial intelligence. And we're just starting to see the beginnings of that translate from the tech sector, where, of course, started, to other sectors of the economy that are going to be the beneficiaries of this very exciting technology. All right, that's it for this week. Don't forget to visit my Substack site, dcnelson123 at substack.com. I have a lot of extras there, including charts from this podcast you'll be able to access. I post there. I also post my network interviews there. And you can communicate with me there. Put in your email address, and I'll try to keep in touch. Thanks for joining. I'm David Nelson, and this is The Money Runner.